Are we live? There we go.
Yep.
All right. Good evening, everybody. So excited to come live to you guys with my two good friends, two amazing dentists right there, Noel and Jonny. My name is Tom. I'm a serial entrepreneur. I started investing in multifamily apartments a couple of years ago, and I saw that how great that is, and how you can build wealth and generational wealth and things like that. And then that's how I got into it. Today we have an amazing topic that you really don't want to miss. It is on how to quickly and easily find the value of an apartment building. So when you see those listings, how do you know if it's true, right? How do you know if the money that the value that they're asking is right? So today we're going to talk about how you can also be an expert in finding the value of an apartment building. Go ahead, Noel and Jonny, introduce yourself, and let's dive in.
Jonny, you go first.
Mute. No, can't hear. No, not yet.
All right, you fix your mic. Yeah. All right, guys. Most of you guys know me. My name is Noel Liu here. I am a general dentist, just like most of you guys in this group. And first of all, thanks all the new members for joining in. And we are really looking forward to drop some, really, really solid nuggets here. So when we are looking at deals, we are looking at deals from a very high point, and we need to see multiple deals. So how do we find multiple deals? That's what we're going to discuss today. It's going to be amazing. Sit tight. And you know what? From here, Jonny, you can go ahead and take over if your mic's working. There you go.
Yes. Okay. Yeah. All right, guys. How you guys doing? I'm Dr. Jonny Walker, or Dr. Jonathan Withanachchi. I'm super excited to be here. I'm an endodontist by trade and a passionate real estate investor. I've had a lot of success investing with multifamily real estate. I'm the principal and founder of a capital firm called Walk of Wealth. We've invested across 650 apartments valued at over $90 million of transactional volume. Most of our partners are dentists and doctors, so mostly dentists, a couple of attorneys and CPAs. At any rate, I look forward to trying to help everybody start this journey to develop streams of passive income. I believe that passive investing is something that all dentists should have in their portfolio, so they can get some true diversity, build some true passive source of income, and then get on a predictable path of building wealth.
All right, so cool. Let's start with some underwriting. Now, when we are doing underwriting, basically we are looking at many deals, like I just said, and we really don't have time to go into the nitty-gritty details and spend a lot of time. So what we do is, how do we scout for deals? And I'm going to let Tom take over, and Jonny and Tom, we're going to share the whiteboard. And Tom, we will start with some makeup examples, and then we will dive into, at the end, into one of the Crexi or maybe LoopNet, one of those sites. And it's going to be all, live. So there's nothing like, it's pre-recorded or anything like that. So let's start, guys. I'll let you guys take over. Yeah.
Guys, what we want to do is, when we go to these units, right, these buildings, they are going to have multiple units in them. So some are 32, some are 64, some are 10, some are like 18. So let's take an example of a building that you came across that's got, let's say, 16 units, right? Let's go with 16. So let's say 16 are 16 units. Okay. Jonny, let's make it 32 actually, because there's that $1 million math. So, that's easier. So 32 units. So Noel, what about the rent? Should we say it's $1,000 a month?
Yeah, let's make it 1,000, because that's pretty normal these days.
Yeah. By the way, guys, this is all impromptu. We all know this math really well, but we have not practiced, because we want to really show you how you can do this on the fly. That's really what it is. So,
and guys, if we make a mistake with the math, please feel free to put it in the chat, okay? Because sometimes we do have the little brain freeze sometimes. So that's why I do it. Tom does it. Jonny does it. Then due diligence team do it. I mean, we are doing this like several times, so just to make sure, like, we don't screw up. Okay.
And please be active in the chat. Ask lots of
Yeah.
questions. If you guys love what you're hearing, give us a thumbs up. Give us some some sign of life. And yeah, we're gonna be answering Q&A at the end. But for now, we're gonna go into, like you said, we're gonna try to evaluate a property and how you can determine the value and see if it's kind of ballpark to what an offering or a broker might be saying this is worth, or somebody or a sponsor might tell you what it's worth. So we're going to kind of give you an objective analysis of how cash flow is used to determine the value of a property here. All right, so we have
So by the way, guys, the value of a property is not like when you go invest in a single family. The value is determined by the neighborhood and the comps. If the neighbor sells the property for 500K, your house is going to be worth around that, right? But when it comes to multifamily investments, it's not related to comps. It's based on this formula that we are talking about here. So 32 units, $1,000 a month. So 32 times 1,000 is going to be 32 grand, right? There you go, 32 grand. That's the
for
rental in
1 month.
Yep.
Right now, in multifamily, we always do it by the year, so we're going to times that by 12 months.
It's 384,000. There you go. So that's the gross rental income that's coming in. If it was 100% occupied, but guess what? Even if the broker says it's 100% occupied, we're not going to go with that because there's going to be people leaving and then turnover and stuff like that. So let's be very conservative and go with what do you think, Noel, Jonny? 90%.
90%.
Yeah.
Okay, so 90% occupancy, that will bring us down to 345, 600.
You know what I'm gonna do? I'm just gonna make it right here.
Yeah.
We'll just call it 345,000 for simplicity.
Yeah, 345, and just put down at 90%.
Occupancy, right? Oh, you can see
right. So 32 units, $1,000 a month, 32,000 a month times 12 because of 12 months in a year. You get a number, and then you take that number, you times 90%, you get 345. Right.
So this is what we are bringing. This is what the property. How much physical cash we will be intaking from the renters. Right. We're bringing $345,000 annually of gross operating income, right, or GOI, we can call it.
Right.
Okay.
Now, Tom, let's go. Yeah.
Go ahead.
No, let's go. What would you do next with expense and everything?
Exactly. Now, all of this is not going to be profit, right? Yeah, let's write that 345 number in big over there, 345.
I'll just write income here.
Yeah, 345. Now, a property is obviously going to have expenses. What are the expenses? Insurance, taxes, maintenance, lawn cutting, all that stuff, right? So the expense there is usually, so now this is a simple math. So we're not going to go line item by line item. We want to calculate the value in 5 minutes. So no, I usually go with 50%. What about you?
50% is a pretty safe number to be at, but in actuality, the expense can range anywhere from 39% to 55%.
Even
for
higher,
example,
even if it's poorly managed, you can get up to 60, 65%.
Correct. And this includes, this includes your tax, your maintenance, your staffing, your management, you name it. I mean, any kind of like, what else? What else can you think of? A lot of times they'll probably have
basically everything involved with the daily operation of the property.
Yeah.
Right? So that's taxes. We're talking about utilities. We're talking about insurance. We're talking about property management fees. We're talking about the HR, the staff that works there.
Right.
Those are some of the major expenses that are involved. And if we use 50%,
if it's in like, for example, you said the range could be like up to 60%. Some states, for example, Texas, the taxes on these are pretty high, a little bit higher. So there it could be as high as 60% in some cases. So So, but for safety, I mean, we just go with 50%, just
Yeah, so
for
this
safety.
50% is just on the operation. This does not include any debt service.
Correct. Yeah.
Okay, it does not include P&I. So this is strictly just the operation itself.
That's a great point, and that's good to understand here. So this is only based the income from based on the operations of the property, and these are the expenses that are required to operate this property. So, like Noel said, this does not include debt service because we have to assume we bought this property with no mortgage. And if we bought it with no mortgage, then we would take this gross income minus his expenses, and the net operating income is what we would be left with. So if we're doing the math here, that we're looking at about a net NOI of net operating income of about 173,000.
Yep. That's what is coming after all the expenses are paid, except the loan payment, right? So 173,000. Let's write that number in big. Johnny,
so that
you're doing a great job.
173, that is your bread, that is your main number.
And it's called net operating income, or NOI.
This is this is a number you have to understand in real estate. NOI is used in almost every single real estate investment that there is.
Is it true, Johnny? That's even for our dental practices.
Yeah,
it's based on revenue, business, right? It's based on revenue. Honestly, it's a form of we do it as is EBITDA, but the thing is the exact same thing. You're putting a value on the cash flow. That's all that this is doing. So now the cash flow that this property brings is it's going to generate $173,000 of annual income. Now, how do you determine what is that worth in terms of market value? If what would somebody pay for a 32-unit property that can produce $173,000 of net annual income? That's
in
what
that area,
in
a particular market,
right?
Correct.
So
that's now, right. So now, what's the factor? What do we use, Noel? What do we do next in our?
I'll let Tom take over. So let's say Tom in Houston. This is Houston, right? Let's say, for example, what is the cap rate there?
It could be about, let's say, 5%. Some places are 4%, some places are 5.5%. So I would say, to make it easier, let's go with 5%.
We just acquired a property in May, right, in Houston. This was a B-class property, and it's in a relatively affluent sub-market of Houston, right? So we're underwriting that at a cap rate of about 5.25. Okay, so let's use 5% as a cap rate in this example. Okay, so let's say that, and cap rate will vary based on the market that you're in, and it will also vary on the type of property that you're in. A riskier property will have a higher cap rate. A more stable, affluent area with a great white collar tenant base might have a much lower cap rate because it's perceived lower risk. So now
here's the thing, Johnny, while you're on cap rate, I want to just talk about one thing. A lot of people, right, when they try to invest in this, they go after big cap rates. Like, okay, I see some 8%, 7%, 9%. Man, I'm going to make 8% of my money. But guess what, guys? Those property. Now, when you see this value, this map that we're going to show you after this, you will see why going after higher cap rates it's not really a great strategy. I used to be like that too, man. I'm getting 8% of my money, But in this math that we're going to show you, the way it is calculated, the value of a building is simply NOI divided by cap rate. So the lower the cap rate, the value of the building is higher. So what is that? 173,000 divided by 0.05.
So 173,000 divided by 5%.
Yep.
Will give us a value of how much?
3.46 million.
3.46 million. So we know roughly that this property in this submarket or this market, Houston, which we know it's about 5%, we know what the average rents are. gross incomes are going to be. And we know that based on this income, the value of this property, the property is now worth $3.46 million. Okay.
There you go.
So now this is where the fun starts, right? So now now this property is a value add property, which is the type of property that my firm invests in. That's what you guys are interested in, is value add. And what value add means is that the property is underperforming. And by adding value, renovating units, renovating the interior,
or simply finding areas to add fees or increase rents,
income, add
right?
income.
That's really the fun part of this. Like Jonny said, that's where the fun starts in this multifamily. Where, like, look at that. So this is not factoring any other income. Like, what are some of the other income, Noel, that we can charge in the property? Other income that we can get from the tenant.
All right, let's start with the admin part. I would definitely say application fees.
Yeah, there you go.
Pet fees, late fees.
So pet fees, how much per unit do you think we can, like, let's say average?
Well, I don't know. I mean, I've seen some places like $10. I've seen some other places like $60. Some places $100, right? It depends on the
$100. Yeah, they are like, yeah.
Let's say, okay. So and we mentioned that this property is not charging for parking. Let's say that we can charge $50 per space for parking. So $50 times 32 units. Now we're bringing in extra how much?
Yeah. So let's do this here.
Income.
Okay. So we add just by adding parking
times 32. It's $1,600 a month times 12.
We'll add $19,200 of net income.
And let's do a 90% on this too.
And divided by a 5% cap rate, that adds $384,000 of value.
Yeah, there you go. That's the fun.
We'll get to that. Okay, so let's say, for example, in the previous example, we said we were achieving $1,000 a month of rent. We know that renovated units in this same building, right? So this is what is bringing in $345,000 income currently, but we know
just with the rents
underperforming. We know that market rent is not $1,000 a unit, but we know that renovated units in that area by buildings across the street built in the same year with the same amenities are getting $1,200 a month for renovated units. So we know that by adding parking, by renovating units, by adding late fees, adding lease application fees. Every time you sign a lease, you gotta pay $25 or $30. But guess what? It adds up. Every little dollar that you add to the bottom line, the net income, is multiplied via the cap rate to a lot, right? So you get a.
What about charging for utilities, electricity, and
that's
water,
right? So that would reduce our expenses, right? So that would reduce our expenses. So that's the other side of it. So you look for ways to drive income up, and you look for ways to drive expenses down, just like in a dental office. So now what happens? Say that we can get an extra $200 a month for this unit. So now what does that work out to? We have 1,000 units, but our new rent, we've added parking, we've added late fees, we've added efficiencies into the operations of the building. So now we can operate the building much more efficiently. So now we're achieving $1,200 a month.
What is that number you have, Noel?
So it's 69,000, but keep in mind this is at a 90% occupancy. Okay.
Times 90%. Okay.
Yeah.
Times 90%. What does that give us?
No, but wait a minute, Jonny. When I did this math, I just did $200 on the delta. I did not do the whole 1,200.
Yeah, let's do the 200 on the delta and then show the $1 million approved math. Then that's probably
that way. That's fine. Yeah. Okay. Sure. Let's do that. Yeah. Okay.
Because we already know it's worth 3.4. We already know it's worth 3.46.
The
right?
Purchase price is 3.4. All right. So now.
Yeah. So we do. So let's do $200 times 32.
Raise rents by $200 per month, right? Per unit.
Yeah. Mm-hmm.
So times 32 units. Times
12. Times 90%.
90%. Which gives us how much?
$69K of additional income in a year.
$69,000 per year of additional net income, right? 120. I just rounded to 69,000. So now we're getting an extra $69,000 per year of net income. That means we're making an extra 70K. Now, how does that translate using a 5% cap rate? Again,
divided by 0.05.
And what does that give us?
1.4 million bucks.
Hold on, we need this clapping for that.
Yeah.
1.4 million.
1.4 mil.
So now, just by driving the rents by $200, nothing crazy. This is nothing crazy. We know that that market is renting for $1,200. They're getting $1,300 a month for a 1-bedroom. We are only getting $1,000. We know that by renovating the units, we can charge an extra $200. So now we're getting just by increasing the rent by $200 a month per unit, we've now generated $1.4 million of new value. That's called forced appreciation. Right. That means it doesn't matter if the market goes up, it goes down, or the rest of the houses in my block, in my neighborhood, they went down. So now my house is worth less. No, the value is based on the income that it can generate. So now we are in control of our own destiny in generating profits. All we have to do is execute the business plan, which is to renovate the units. As long as we renovate the units and we get the rents to what it's supposed to be, we're not trying to go aim for the moon, pie in the sky. No, we're going for what the market dictates. So what the laws of supply and demand dictate. And as long as we do that, we will generate the profits and returns that we're looking after. So now we took a building. How much did we say it was? We bought 3.46. It was what? 3.46 million purchase price. We add 1.4 million on the sale. So now we're selling this property for $4.9 million in 3 to 5 years later.
Yes.
And that answer, and that answer was one of the questions when somebody was asking, oh, what about the tenants? Well, the tenants are not going to be like, yeah, if the tenants are in, you cannot do it. But of course, like at the end of the day, we're looking at a 3 to 5 year hold. And now in a 3 to 5 year old, I mean, it could be more than $200. We still haven't accounted for additional income. We still haven't accounted for cap rate change. There's still a lot of things that goes in play.
And you're getting a cash flow every single month on top of this appreciation. That's what
we should have done this cash flow analysis on this thing too. Maybe we can do that on the net on another.
No, we can do it right now. So it's 173 of NOI. Right, the PNI. What is the I right now?
We know the net operating income of this property currently is $173,000 annually, right?
Yeah.
Say it's got a cash on cash return of we're not going to do cash on cash because we don't have any debt service. But all right, yeah, I'll let you carry here, Noel. So say we're getting so we have a net income.
No one's the expert in debt.
Right.
So let's do this here, guys. So 173,000. What we'll do is, let's say the interest rate is, I don't know, you want to make it up? Let's say around 5.75.
Sure.
Right.
Yeah.
And now that's interest only, but let's add in the P, which is the principal. The principal usually amounts to about, like, let's say 1 to 1.2%. So what is 5.75 plus 1.2%? So you probably get like about like a 6.9, let's say 7% combined. Okay.
Okay.
So now let's say we do 173,000. You do 7%, 12.1 times 12. So that, ladies and gentlemen, that's a debt right there. PNI at $150,000. It's 145, but let's round it out to 150. What was our NOI?
173.
173. All right, but here's a good part there. As long as we clear the debt service clearance of 1.25, we're in good. However, we are not paying banks this number. We are paying bank at IO only. IO for the first 3 to 5 years.
Right.
Okay? Assuming that's the debt, the structure.
Yeah.
Yeah, but that's about it. And then and actually with this example, $145,000 debt service versus versus 173,000, it's the debt service coverage
1.19.
ratio is skewed.
Yeah, 1.19. That's what it's coming up
about
to.
84%.
Is that interest only?
No, that is PNI. But we got to keep in mind we are just playing around with the numbers, okay?
Numbers, right?
Right. So now let's say if I were to do a number, if I were to do this underwriting, if I'm looking at this deal and I'm coming up and I go like, hey Johnny, you know what? This debt service is coming to 1.19. I don't think it's a good deal, dude. And Johnny's gonna be like, hey, you know what? Let's talk about reducing the price.
Yep.
Mm-hmm.
Because
okay, let's take a different number.
At that level of income to the debt service, the bank is not going to make that loan because they're going to want at least a 1.25.
1.25 is the key,
right? Yeah. Minimum, right? Minimum. That they feel comfortable. I think this is a good place for us to maybe start. You want to start looking at some questions here?
In a little bit.
Did you want to show a live deal, guys?
Oh, yeah, Crexy, sure. Let's
but you know what? Before we jump into that, I just want to change a few parameters right now with this deal. Let's go. You know, like somebody asked, how do you know it's a 5% cap? Well, you know, that broker, I mean, it's available everywhere. CoStar you can get a lot of information from like some of the websites like CoStar, Crexy, or you can get it from the broker, or you know, even the market that was last traded. Now
that's actually a great question.
That's a very good
how'd you get the cap rate?
Yeah.
Go ahead.
Yeah. Cap rate is not something that's just listed somewhere. Mm-hmm. You know, it's not like you can just look it up. It is,
but you can find it through paid services, right? And even the broker within that certain, you know, that zip code, up to that zip code, it can go.
And if you ask the broker, I mean, he's going to give you a number, and you got to always take that with a grain of salt, and then do your own research to find out if that's. And it depends on the location, type of property. If it's an A-class property, the cap rate will be lesser. If it's an older property, cap rate will be higher. Things like that. So
and I'm going to run this risk too. You know, like
I'm going to run this one example where we take that 173. Mm-hmm. And now instead of dividing it by 5 cap, we'll divide it by, let's say, 5.5 cap.
Yeah, exactly.
Okay, yeah, right.
We didn't do that.
Right?
We should,
okay. How much difference does that make? So at a 5% cap.
What did we get? What did we get for the valuation on the first one?
I think it was 34.6 million or something.
3.6?
3.46.
3.46, right?
Oh, 3.4.
Johnny, that's 3.4. Yeah. Yep.
All right. So 3.46. So let's do this here. So 5.5 cap divided by 5.5%.
3.14.
145.
Yep.
So ladies and gentlemen, here's the thing. 3.145. That's like a difference of $300,000 with just 0.5% of your cap.
Cap rate. Yeah. Because it's a factor of 20. It's a factor of 20 when you do it like that.
So now our debt service is going to be different.
Right. Debt service. Yeah, within your debt service in. Exactly.
And also keep in mind, when we do that forced appreciation, that let's say you're in a newer building, that value, that'll increase the valuation of the building higher because the cap rate will be lower in a newer building. But if it's a little bit older building and if the cap rate is 5.5, that valuation, that bump is going to be a little bit lower.
Yeah, so that's when you're talking about repositioning, right? When you're repositioning from like a C to a B property, cap rate might actually be lower. So you might buy at a C cap, make the renovations, you drive up the income, but now instead of a 5.5 cap you might have bought at, but now it's a B property, which is perceived as less risk, more desirable. As a result, people are willing to pay more for it. And as a result, they pay a lower cap. So then it might be a 5, you might sell at a 5 cap. So that's another source of driving profits essentially. Go ahead, Noel, what you were saying about that?
So let's say at 5.5 cap, let's round it off to $3 million and we get a 70% off loan, right? So we are borrowing $2.1 million. And technically we put in what, 900K down, right? Just for the purpose of simplicity here.
1 million equity, let's say.
Okay, 1 million. Let's put 1 million equity.
So this is investor capital, right? 1 million. We have to come up with 1 million. The bank is going to lend us 2.1 million to buy this property for
to buy the
3.15
property.
million.
Right.
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 So
I mean, the
so
1
we do
million
that.
equity, either we come up or we raise from the investors. So that's how that
Correct.
equity works. Anyway, we don't want to get into details.
Yeah, let's not go into the weeds too much here.
Yeah.
Um,
But this is a great example, like how the cap rate, and whoever asked that question, it's a great question, and it's a great example of cap rate fluctuations can show the difference in valuation of the property.
You know what? I
That's
think this is a good juncture to answer these questions because we don't want to go too far. Okay, go ahead. What's this, Noel? This is
No, so this
140.
last one. So this is the last piece. That's a debt service.
Okay.
Okay.
That's annual.
That's annual. So you do the annual. So our annual NOI was what, 173?
Yeah. So that
Minus
gives us about 33K. 33K.
33K is the cash flow.
Cash on cash. That's the free cash. That's actual cash in your pocket.
After everything.
After you paid the bank and you paid all your expenses and paid everything.
Right.
Right.
And here's the thing. This is not even the back end of it. This is just the cash flow coming in where we're going to
cash
distribute
flow analysis.
investors.
Correct. This is cash
But
flow.
once when all the units have been cycled in and everybody's rent has gone up $200, guess what? Your NOI will automatically go up, and thus your value will go up.
Yeah. Yep.
And that's how every investor gets money at the back end.
Correct. That's right. Well, I mean, when we're doing the when we're doing it by the cap rate, we're getting kind of the end value, right? So.
Yeah. Absolutely. Absolutely.
Yeah. What's the usual maintenance? I'm assuming that question means what's the expenses or the expenses? Typically, like Noel said, is usually between 40 to 50, between 40 and 60. Can vary a lot depending on the quality of the management, the efficiencies of management. Usually a management fee is paid, because when we have large apartment buildings like that, we can afford to have professional management. And usually they charge anywhere between 4 to 8% of gross rent, right? So that's usually the cost.
Jonny,
I also by including it as a line item. Go ahead. What'd you say, Noah?
Jonny, I also want to touch on that in terms of what they're asking for is like, so this is the quick math of how we figure out the value, and then we decide, hey, should we take a second look, deeper dive into the property, right?
Right.
We are not going to buy the property based on this. The broker is going to give you all the details of what line item expenses. This is how much they spend. And that's how you're able to see, okay, when you add it up, it's like, okay, now it's 50%, it's 40%. Sometimes they will be like, oh man, expenses are only 30%. I mean, you should question that. So what I'm saying is that before you go into the real deal, before you do the transaction, they will give you like the complete expenses and the income, every unit, and how much the rent's coming in, what is the expense, what is the taxes, what is the insurance, all that will be given to you, and then you can do the underwriting after that. But this is just a quick way to figure out. Almost all the time, this is pretty accurate. What do you think?
Yeah, back of envelope, right? Like back of envelope.
Yeah, the napkin underwriting.
This will tell you if this price is in the ballpark or are they out to lunch. Like, all right, as soon as we see it, if it's way out of whack,
you're like, bye-bye. We don't
spend time doing extra due diligence going into it. Only if these rough calculations are even within the ballpark, is it worth to go further due diligence into the property? This question is principal and interest included in expenses. This is not an expense of the operations of the property. This is the principal and interest is an expense that's a function of the financing, right? So if you buy a property, so how the property operates is not affected by how you pay for the property or finance the property. So that's why that principal interest, the debt service or mortgage payment, is not included as an expense and is not included in the calculation of the net operating income, because how one buyer might finance or buy a property might be very different from somebody else, right? So that's why that's not included. That principal, when you're the principal and interest expense is included in your final cash flow analysis. When you're doing a cash on cash return, how much money is actually going into your pocket at the end of the year, that's where the debt service number comes into play. But in terms of NOI and calculating the value of the property, there's no debt, there's no expense, principal and expense interest included in there. Good question.
Right.
We will get, okay, so next one, how can we? I love this one, and I would love to take this question because we're doing this right now in a property that is 95% occupied. It's a 40-unit property, and this was one of the things that we don't want to kick tenants out. Like, well, how does this work if it's 90% occupied? How can you renovate units and get new tenants in and raise the rents? So the question is, how can we renovate with tenants in it? Do you not renew the lease to do it? So the first thing you do is the logistics of it. The first thing you do is renovate the free units, right? So if there's a vacant unit, you're already not getting any income from that unit, right? So what you do is you go and renovate the unit so that you can charge market rent. In this example, this 32-unit building, we want to charge $1,200. It went from zero to now producing $1,200 of income. Or the other thing you do, you renovate that unit, and then naturally, around 20 to 30% of leases people will naturally just leave the property, right? Those are the next units that you go in and tackle and renovate. If there's a good paying tenant, strong paying tenant, their lease comes up. Remember, leases are renewed every 6 to 12 months in multifamily real estate, which is what allows us to adjust the rent, which allows us to adjust for inflation. Inflation is really high. We can, hey, the year is up. We can raise the rent, and we can, the cost of everything business went up for us. Cost more for concrete, cost more for lumber, cost more for staffing. So now we can reflect this by raising our rents. And we can do that every 12 months. It readjusts every 12 months. Now, if you have a good, strong paying tenant, the tenant's been living there for many years, they've been paying you on time, you don't want to lose that tenant. So what you can tell that tenant is, hey, your lease is up. We have a brand new renovated unit. You can move into that brand new renovated unit at this is the new lease. Or we're going to raise the rents a little bit on this existing unit. We might not raise it to the full 1,200 if we're at 1,000, but we might raise it to 1,125, for example. So we have a lot less loss to lease, as it's called. So that's how you slowly start increasing it. Now, as tenants move out, there's a 30% attrition naturally. That's when you go in, renovate those units, and move new tenants into those units. Eventually, sometimes it comes down to, and that's how the basics of it is. You slowly start moving the tenants out. Then there's going to be some tenants that hang on, that they don't want to leave. They don't want to pay, and they're legacy, they're called legacy tenants. And then we may use other techniques like cash for keys. We have a TRIP program. It's a tenant relocation incentive program. So we find the tenants new places to live. Sometimes we even pay the tenant to leave.
Here's another thing along those lines, Johnny. So, some cases, like some of these properties, what we are finding in some of these hot areas, they have been managed by a family. They have become so friendly with the tenants. They have never raised the rents in 6-7 years. Guess
and that
what?
creates a huge opportunity, right?
Opportunity. So when we look, it's like 20-30% below market. It's like, guess what? New sheriff in town. Sorry, new management, rents are going up. So you don't even have to do anything in some cases.
Sometimes you just go in and raise the rents.
Go in and raise the rents. That's the best.
Yeah. And that comes down to buying right. In real estate, like they say, the profit is buying, and when you're buying, and that's going in and finding usually the best deals is somebody that's owned the property for a long time. It's paid off. They just use it for cash flow. They don't care. They don't even know what the market rents are. They just know this. Mr. Jones has been living there for 30 years. I feel bad. I don't want to raise the rent. They don't have to raise the rent because they don't have any bank loans. And as a result, they're only getting $800 a month. They don't know that they could be getting $1,200. So now we just go in and we buy the building. We don't even have to renovate the units. We're like, all right, we can just start charging $1,000 right away, as is. Yeah. And then the property value jumps up $1.5 million, just like that. So add parking. You add $400,000 of value to this property just by adding parking. Just creative ways that you can add income. We've had a case one time where we put a cell phone tower on a roof. My partner was just an ingenious at figuring out ways to figure out new ways of income. He's like, hey, look, this roof space is not being utilized at all. And he started reaching out to cell phone companies and say, hey, we can rent you the aerial rights to put an antenna. And a big cell phone company said, you know what? We're going to do a 15-year lease and we're going to pay you, I forget how much it was, but it was like $8,000 a year or something like that for 15 years. Then you're just going to put, and it's a space that you weren't going to use it for anything anyway. And $8,000 of income.
I would have done $8,000 a month
at a 5% cap rate, right? It adds $160,000 of value just by renting the antenna space.
Additional income, my friend.
On the side of the building. Run ads. Verizon Wireless. Oh, you're near a highway. Put a huge Verizon Wireless sign on there. Rent it to them, $3,000 a month. Oh, that's another $200,000 of value. And just like that, you can add on, bump. Income, value goes up, and the profits go through the roof. That's the beauty.
One thing I want to add to this here is you're not in the business to renovate 100%. Okay, so a lot of people are like, hey, we are going to wait till the whole thing is renovated. No, you don't have to do the whole thing. Our job is to go in there, renovate at least 40 to 60% and get out.
You want to drive the net income high enough that you can achieve your returns.
Yes.
Right.
Whether it's done by only renovating 10 units, whether it takes 50 units, whether it takes half, whether it doesn't take renovating units at all. Because in 2021 and 2020, multifamily real estate values were soaring.
Scott, right.
People were buying properties and literally selling it 18 months later without doing anything to the property. And getting a ton of value. That was a one-time gift we got to us, ladies and gentlemen, in multifamily real estate. Yeah, we're not going to see 25, 27 rent growth in 1 year again.
There's another.
We were able to capitalize, and I invested heavily in multifamily during this time. But
there's an important question somebody asked.
Normalized growth at this point. We have to look.
There's another question somebody asked. I own a 6-unit building. The question is, I own a 6-unit building in the middle of Illinois. Unfortunately, we don't know what the market rent is. How do you figure this out, right? So, I'll take this and then you guys can go after this. So, easy way to figure it out is rent.com. You go there and then differentartments.com and figure out what the market rate is. But if you're in the middle of Illinois and there's like only 2 or 3 buildings over there, it's really hard to find out, right? Here's a simple method you can use. Basically, simply start raising the rents with one tenant. Just be like, hey, costs went up, inflation. Example, inflation, all my costs are up, property tax, insurance is up. Guess what, guys? I have no choice. I have to bump it up by 150. Look at the resistance. Like if the first guy says $100, he's cool, go with the second guy and then say, okay, it's going up $100. And I did this actually on one of my properties. It's like we started it was at 1,200. We bumped it up to 1,350 with no resistance. Then I was like, man, why can't I try 1,500? And guess what? I tried 15, but that was a renovated unit and that worked. So now to anybody coming in new, it's 1,500. So you can test by testing it on one tenant. If you don't have any market data, just simply raise the rents and see if they will take it. And also run some ads in that area, Craigslist or something, for say, hey, apartment for rent, this is the rent, and see if you get some bites on that. So that way if people are willing to pay that kind of rent. And when they call, it's like, hey guys, I'm firm on the rent. This is my rent. If you don't have market data, that's what I would do. What do you guys think?
Yeah, and central Illinois, that's kind of around my neighborhood, right? So
that's you, right? That's your Peoria right there, right?
Yeah. So it's going to be like, is it a 2-bedroom? Is it a 1-bedroom? Is it a studio? So 2 bedrooms. You could definitely see around maybe like in the area, if it's like fairly new from the 80s and 90s, it's probably around like 12, 13. I've seen it as high as $1,400. Single bedroom, you probably look at it around like 900. Okay. So
the best way, whoever asked that question, to me, the best way is to call brokers. Call local brokers, look at that market. There's usually going to be a few people that are specialized in that market, right? In that area of Illinois, and simply call them up.
Decatur. She said it's in Decatur, Illinois. Very
Decatur, Illinois.
Well,
I would Google Decatur, Illinois real estate agents that are in the type of property you're looking for. If it's apartment buildings, even call them up.
But I can tell you, like,
be a secret shopper. Call up a building that has units for rent already. How much is the rent for 1 bedroom? How much is 2 bedroom? How old is this building? You get an idea for the property. Is it similar to what your target property is? And then you call the next property. Start making an Excel spreadsheet. The year that it was built, the vintage, the unit type, 1 bedroom, 2 bedroom, 3 bedroom, bedroom, bathroom, and price, right? And start making a list. Then you have like 5, 6 subject property. That the vintage, what the year is, whether it's, you might even put in another column for class, just give a loose classification. You think it's a class A or it's a class B, based on what the phone call told you based on the amenities. I mean, the local expertise of brokers is what that's what you pay for when you use a broker. And so they know that local market better than anybody else. So those are the people that I would talk to about finding comps. That's
but
that's
Decatur,
how I would approach it.
That city, Decatur, I can tell you right now, the cap rate is somewhere around close to a 6.
6, yeah, I would say, yeah.
Sounds about right.
I
mean, it's a little bit more of a secondary, tertiary market.
Yeah, absolutely. It's a complete tertiary market, and then of course, depending on what the demand is over there. But if it's a 6 unit, I would say 6 unit shouldn't have any problems, getting out for even somewhere around like a 12 to 1250 range for 2 bedrooms.
Tertiary markets will slow down a little bit, in recessionary times, but maybe not in that.
By the way, the example that I was giving about me raising the rent, that's in the suburb of Illinois too, but not that far. It's in the suburb of Chicago. I meant, suburb of Chicago. So anyway,
okay. So I think we have to cover this question.
There's a couple more questions.
Yeah. How did you get this 5% of Houston? We got the 5% of Houston because we actually, just like I said, we bought a property in July, 300 units in Bear Walk, a submarket of Bear Creek, submarket of Houston. And in Bear Creek, the going cap rate for the vintage of property that we were buying was a Class B value add property, was 5.5%. And so that's why we just used 5% instead of 5.5 just because for ease of calculations. How much does it cost for the renovations to get the 1.3 million in profit? Again, this is a very, very good question. And this is going to determine your rates of return. So as we discussed, to get that 1.3 million in profit, we have to raise net operating income. In order to raise net operating income, it depends what you have to do to get that done. Is it what we call where the market's just real estate went up and everybody's property went up? In markets like that, you might not have to do a whole lot at all. You just have to rent out the space and people will just start paying more and more because inflation is driving up rents in all the other properties around you. So you can charge whatever all the other properties get and you generate that 1.3 million in profit. Then you might head into times like this recession. Like we're headed into a recession and we're headed into a deepening recession as a lot of people forecast. In times like this, you might have to do more to generate that net income, right? To drive rents, you might have to spend more. That's called capital expenditure budget. So the CapEx budget is factored into the total cost required to do this investment. And so the more dollars that's required to do the investment, the lower the returns are when you are evaluating returns, right? So profits. So the answer to that question is to generate 1.3 million in profits. You may have to do a little, you may have to do a lot. It depends.
And there's another question related to that is they're saying, do you get a loan for the renovations? Absolutely. That's called CapEx. When you buy the property, go ahead and explain the CapEx, Noel.
Yeah, I need there's 2 answers to it. I'll let you explain the CapEx. I just want to reiterate 2 things on that part there. So
go ahead with that. Just go ahead and explain.
With a rehab, you have 2 options. It depends on the sponsor or whoever is putting the deal together. So you could actually put it in the financing or you could actually put it in the equity portion. Now, just keep in mind, if you put the rehab with the financing portion where it's under debt, the bank is going to be telling you when and how soon you have to use that money up, and they are basically dictated by the banks. Now if you put it on the equity portion where you raise the capital and now you have that rehab budget on the side, guess what, now you can just play it at your own terms. So there's pros and cons to it. I'll let Tom carry on with the CapEx.
So a capex simply means capital expenditure. So, like you said, before you go into the property, when you're looking at looking at the property, the numbers, how the property is, you'll be like, man, we got to renovate 50 units, right? So we put in a budget for that. Let's say $5,000 a unit times 10 units, $50,000, and we put that money into the cost of acquiring the property. Go tell the banks, hey, this is how much it's going to cost, and this is what the capex budget is, and that's what we want the loan for. So we increase. So let's say somebody's asking $3 million. We came up with 50,000 to renovate the property. So we'll be like, we need a loan. The total cost of this project is $3,050,000, and we go to the bank and present the case that this is what we want, and then we go about the numbers. So capex is called capital expense. Yeah, absolutely, you can get a loan to do all the rehab.
Mm-hmm.
Yeah, bridge loan. Sometimes we
right.
call it bridge financing as well, or
Yep.
mezzanine financing, which will bridge. It's called bridge financing because it literally bridges the gap between buying the property, which you might get a mortgage, and then actually, renovating the property. So it's called bridge financing sometimes in order to, get the capital expenditures done.
Noel, you have a question from Jeff. He's asking, are you seeing multifamily deal flow slowing down?
I wouldn't say necessarily slowing down. It all depends on what the other party's exit strategy is. What do you guys think? I mean, I've seen a lot of cases where those guys are just holding on to it now since the price have dropped, right? And some of those guys are still selling it because that's in their, PPM, or it's in the model, in the business model.
Trying to get out before the market. Yeah. I mean,
some are scared, so they'll get out.
Yeah.
And some of them are forced to sell because, that's where their business plan is, where they have to return the money to the investor. So they're forced to sell. So regardless of whatever they get, they'll have to sell. So, yeah, I mean, slowing down, I don't know. I mean, not necessarily. I mean, the deals are out there. What do you think, Jonny?
I mean, to me, I feel like the deals are slow. I think they're slowing down. I think they're going to slow down even more as the interest rates go up. There's reasons.
No, are you saying slowing down in terms of transaction or slowing down in terms of deal flow?
Deal flow. Transaction has gone down, but the flow.
Right.
Yeah, but the flow is still there.
The flow is still there.
I think it's, it's hard for me to quantify it, but definitely the amount of private equity available has slowed down. So
that's the transactions, like the deals closing has slowed down. But what about people wanting to sell? Like,
I still think you're going to see that slow down also, because if cap rates are expanding, right? Because interest rates are going up, people aren't making the huge offers that they were just getting 6-7 months ago. So if you're not in a position that you're forced to sell and you're cash flowing, you're not going to sell, and the same thing goes on the buyer side. If interest, for example, there's a property that I don't want to tell too much details because we haven't closed it yet. It's a 40-unit property, right? Now we are locked in at 5.12% interest, okay? Because we started the loan before. We have until October 13th to close. If we don't close on October 13th, we lose that rate. And guess what the new rate is for the exact same product? We got a 5.12 IO. It's going to be 6.8%. At 6.8%, that property, that the price that we're buying it at is no longer feasible. So that means either we drop out and say, look, we're not buying this no more because we can't afford it at this price. And by the way, we have $50,000 hard money down on this. So if we don't close on it, we just lose our $50,000. So imagine that you go to 6.8% and all of a sudden the price, your monthly payment goes way up, and now the property cannot sustain that value anymore. So I think what you're going to see is that and we're saying that interest rates are going to continue to go up. So I think that volume is going to go way down, but, and there's a big but here, opportunity goes way up when everybody else is scared. I've heard a lot of people that buy multifamily, hey, I'm just going to wait back a little bit, 6 months or 8 months, because I want to see what happens with these interest rates. Things are slowing down. I'm just going to wait and see. Same with investors. Another, and somebody quantified and said private equity for syndications has gone down by about 30% now. Why? Because where do a lot of people get their slush funds to invest in these properties? They take it from their stock market. They take it from their crypto accounts. But when these are dropped way down. Crypto is half of what it was. Stock market's down 30 and is going to drop even more. Now all of a sudden the cash that was available to invest in these properties is not there. That was once available. That's one. Number two, we have so much doom and gloom in every meme I see, every news line, every headline. We have a deepening recession. Things are going to get really bad. We're going to see flat. Stock market's not going to come back for 10 more years. XYZ. We're seeing all this anti-sentiment. Natural inclination of investors is to get scared. Scared investors are not investing, right? But what happens is
scared money don't make money,
right? So that's exactly right. So now the people, like a lot of my partners, they're ferocious buyers during times of uncertainty. They're going out and buying because guess what? As Noel said, depending where you are in your cycle, maybe you have to sell at this point. Maybe you have a family emergency. Maybe you need to move. Maybe there's a death in the family. Maybe there's a divorce. Maybe there's. But there's always something happening where somebody has to sell. Somebody's in a position where they have to sell. Now, if they're in a position that they have to sell, but there's nobody out there buying, guess who gets to pick it up at incredible terms and prices and rates? It's the guys that are still active. So that's why I'm very bullish in multifamily, especially during a recession, because when great times of uncertainty is when great wealth transfers happen. And people that understand that is going to see wealth transfer from the people that don't understand to the pockets of people that do, right? So the great resets, they happen all the time. 2008, it happened. 2020, it happened. And we're going to see that in another recession we're headed for. They're saying it might be bigger than the great financial recession that we had in 2008. Will we see resets again? House prices are way high, right? Everybody, so where does it go from here? I know I wouldn't want to have my money stuck in the bank. Inflation's still running hot, right? Might have slowed down, but it's still running. I don't want my money in the bank because of that. I don't want to be in the stock market because it might go down for another 5 or 8 years, or 10 years before it comes back. That's a poor place to be, right? I don't want to do cryptocurrency because who knows what Bitcoin's going to be worth. Maybe it's going to be worth $1 million. Maybe it's going to be worth zero. I don't know. I definitely not buying single family homes. The price is already way too high. It's very hard to get any type of arbitrage when interest rates are so high. So I'm going to stick to multifamily because multifamily still has that great thesis. There's an affordable housing crisis. People are still going to need a place to live. Renters will remain renters. People that can't afford to buy their house anymore, they will remain renters. Apartment buildings traditionally do very well in recessions. They do even better during bad times because people are not going and buying stuff. They're living where they're going to rent where they live. They're going to stay where it's cheap and affordable. People start moving in together. Now they have all this stuff. They need to put it in self-storage. Self-storage will do good in recessions. Right?
Anyways.
These mobile home parks, more affordable housing. These are the asset classes that I think will perform very lovely over the next five years. Is mobile home park, apartment buildings for sure, mobile home parks and self-storage, ATM funds, anything dealing with recession resilient type of people, which is workforce housing, right? So,
all right, guys. So we are almost close to an hour.
Yeah, let's wrap it.
A couple more questions, and
No, let's go with the questions real quick here, and just on a side note for Jonny there, when your interest rate goes high, just keep in mind that the bank is your partner. They will make sure that, the deal is closed at a favorable rate, and they may even go for a retrade with a seller. So that may also be a possibility.
Yeah.
Yeah.
Let's go. Do cap rates vary in different markets and for different RE assets? How do you know what cap rate numbers to pick when doing this analysis?
I think we went over that answer before. Basically, cap rates vary by market. You got to ask the broker. You can look at Crexy. You can look at some deal analyzing software. And also some of the deals that have happened. There's so many tools available online to find that. Also ask the broker, but always take that with a grain of salt and do your own research. It varies by market, by property, what class it is, etc. So
cool. Let's get to this last one here, right? What kind of insurance do you get on a property that And how do you factor in an act of nature? I'm sure the property didn't flood, and hopefully it doesn't ever happen. I'm only asking because I had to rescue people in Bear Creek during Harvey.
Yeah, that's actually a good question, and that came up. And actually, where our property is located, and there is floods in Bear Creek, but where our property was located in Bear Creek was not a flood, was not in a flood zone, thankfully. That otherwise that may have killed the deal. I mean, our group, if we have, if you're in a flood zone of one every 400 years or less, as they call it in insurance terms, we won't even do the deal. You know, like that's a deal killer. But there was an analysis done. The probability of Bear Creek having a flood was very, very low. Not Bear Creek, where our property was located in Bear Creek had very low likelihood, and as a result, the insurance reflected that.
But
However,
to answer that question, that it says,
Yeah.
what kind of insurance do you guys get? Basically with the Sunrock team, there's an insurance broker, and then the broker also will have to keep looking at the property, the same property, but with different insurance carriers, because every year they keep changing them. So it's
they
not like
shop
the
around.
same carrier, right? So if you got a carrier that will do Houston or they will do like San Antonio, it's not necessarily the same carrier will do it next year, because it all
However,
depends on their risk analysis. Yep.
But keep in mind, like anything happens to the property, insurance will cover that.
Yeah.
So it's all insured
up to the limits.
up to whatever that limit is. But what Johnny was saying is, you don't want to buy in an area where the insurance may be way higher and your profit is less, right? Like for example, what's going on in Tampa right now. I mean, the insurance is going to go through the roof after this for every property over there, right? That's what I'm guessing.
Earthquake zones, like there's top the hurricane, areas with natural disasters, and we're starting to see that there's less subsidization by states on these natural disasters because they cost so much money. And if you're in a place with hurricanes and stuff and property insurance spikes to $1 million a year a premium, all of a sudden that real estate is not valuable anymore.
Your cash flow, it kills your cash flow.
For sure.
All right, guys, we are exactly. Go ahead.
Yeah, that's why when we do this deals analysis, we kind of have to make sure we already got like some sort of a number for the insurance, some sort of a number with your property taxes, and also the property taxes after trading, because they will give you the numbers before trading. You also have to factor in like what's going to be after trading. So there's a lot of underwriting that goes in besides what we just did, like behind the napkin kind of underwriting. But that's just to kind of give an analysis, like an overview, like if the deal makes sense. But all this work will be going under after when you put the deal under contract.
Great.
Guys, do we have time for a
I think, Noel, we should do it for next
time. Okay.
Yeah, next time, because it's already an hour, and it'll be a good segue to go into that, and like maybe look at some places where we can find properties.
Yeah, let's make the announcement now so that everybody will be ready for next 2 weeks when we go live. We'll do like real live deals from Crexy and LoopNet. Okay,
guys, I hope everybody got some value out of this. Keep asking the questions. We'll be answering them even after the live is over, and this will be restreamed again. But
should we do the restream Thursday or Friday? I mean, I guess we can have this discussion off air, but since we just did Tuesday, maybe we do Friday just so people know. I don't know. What do you think?
Yeah. I know there was a question in the chat that if it's going to be when it's going to be replayed. So let's announce it Friday.
Yep. Friday. And when is our next call? It's
2 Tuesdays. We're going to be every second Tuesday at 6 p.m. Central, 7 p.m. Eastern.
So the next one is October 11th.
October 11th, and then October 25th. Yes.
All right, October 11th, 7 p.m. Eastern, 6 p.m. Central, right here, Facebook Live. See you, everybody. Thank you
everybody
guys
for being
joining.
here. Appreciate it so much.
Thank you.
Appreciate
Have a great evening.
All right, guys. Thanks so much.
Bye.
All right. Bye.